Shanghai is screaming one message. I don't care what the paper price says, pay up or get nothing, because the Shanghai benchmark just printed a level that, when you translate it into dollars, lands in the 90-something zone per ounce, while the Western screen price is still fighting in the mid-80s. That gap is not a typo. That gap is the sound of a physical market trying to break free. And now analysts are using a word that only shows up when supply chains snap. Force majeure, not delays, not tightness. Force majeure, the legal phrase that means we can't deliver and the contract can't punish us. So in this video, I'm going to do 3 things, step by step. Show you what Shanghai is actually pricing, explain why inventories there just hit a decade low, and why that matters more than headlines. Walk you through the force majeure chain reaction, who declares it, why it spreads, and what signals tell you it's already started. The $95 Shanghai moment. First, the headline, silver hits $95 in Shanghai. You might be thinking, wait, silver is around the mid-80s. Where does $95 come from? Here's the trick. Shanghai doesn't quote the same way your broker does. Shanghai's benchmark is published by the Shanghai Gold Exchange as a physical benchmark price for silver. It's not a futures chart, it's a physical reference point for metal changing hands. The benchmark is quoted in RMB per kilogram. So when you see a number like 2421 for the Shag silver benchmark, that's RMB per kg. Now convert it. 1 kilogram is 32.1507 troy ounces. So 20,421 RMB kg, 32.1507. Roughly 635 RMB per ounce. Then translate RMB into dollars using the USD CNY rate sitting just under 7. 635 RMB per ounce, such as 6.97, such at around $91 per ounce. That's the benchmark. Now add the real-world layer, premiums, VAT mechanics, logistics, urgency, and immediate demand. In a tight market, benchmark becomes the floor, not the deal. Let me slow it down for 10 seconds because this is where people get confused and start calling everything fake. Shanghai is quoting in RMB per kilogram. New York is quoting in dollars per troy ounce, so you must convert. If you skip that step, you'll think Shanghai is wrong. It's not wrong. It's speaking a different language. And once you translate it, you see the real headline. Shanghai's physical reference price is sitting well above the Western paper reference price. Now add the second layer, local cost structure. Inside China, silver trading can carry VAT and financing costs. It can also carry urgency premiums when fabricators need immediate metal, so the all-in delivered cost can jump higher than the headline benchmark. So when you hear $95 Shanghai, don't picture a magical new planet where silver is worth more. Picture a market paying for immediacy, paperwork, and certainty. That's what premiums are, certainty fees. And in a tight physical market, certainty becomes priceless. SGE, Shanghai Gold Exchange, publishes benchmark prices for physical metals. SHFE, Shanghai Futures Exchange, where the warehouse on-warrant stock numbers come from. On-warrant, registered in the exchange warehouse system, visible deliverable supply, backwardation, near-term metal priced higher than future metal, the market paying for now, allocation, rationing by suppliers, you get a portion, not the full order. Force majeure, the contract escape hatch. Performance can be suspended when events outside control make delivery impossible. Keep those 5 words in your pocket. They're the whole movie. If you want to verify this without trusting anyone, here's the simple routine. Pull the Shanghai silver benchmark price for the day. Note the RMB kg number. Divide by 32.1507 to get RMB AOZ. Divide by the USD CNY rate to get USD AOZ equivalent, compared to the nearest COMEX price. Do that for a week, and you'll see whether the spread is a one-day anomaly or a structural signal. And here's a pro tip. When the spread widens on a day the paper price is flat, that's when physical is quietly tightening. The market is telling you the chart is behind reality. In a tight market, benchmark becomes the floor, not the deal. And that's how you get prints and quotes floating in the 90-95 zone in Shanghai, while New York is still blinking at $85. So don't get trapped in one number. The story is the spread. The story is that Shanghai is paying more for real metal. And when the physical hub of Asia pays more than the global paper hub, the market is telling you something. Availability is the product. Silver is no longer a price. Silver is a line item you have to win. Now, why is Shanghai doing this? Because the vault is thinning. The decade-low inventory problem. You don't get a premium like that in a normal market. You get it when warehouses are draining. And the key phrase in the context you were given is this: physical inventories in Shanghai hit 10-year lows. Let's translate what that actually means. In China, one of the most watched metrics is the on-warrant stock of silver held in Shanghai Futures Exchange warehouses. On-warrant means the metal is registered and available against contracts in that system. It's not hidden in someone's private stash. It's the visible supply that matters for settlement behavior. And the data that's been circulating recently shows those on-warrant stocks sliding to their lowest levels since 2015, roughly in the 531,000 kilogram range. Let's make that real. 531,000 kilograms is about 17 million ounces. 17 million ounces sounds large until you place it against global industrial demand, investment demand, and the reality that silver is consumed. Silver is not like gold. Gold gets hoarded. Silver gets used, fabricated, soldered, plated, and scattered into millions of products that do not come back. So when the visible Chinese warehouse pile drops to a decade low, it's a warning flare. It means any export shock, any refinery hiccup, any shipping choke point instantly bites. And here's the part people miss. Inventory doesn't collapse because everyone is suddenly paranoid. It collapses because the flow is outpacing the flow in. Either more metal is leaving than arriving, or buyers are refusing to release metal back into the system, or both. Now I know what someone will say in the comments. 17 million ounces? That's not zero. Why panic? Because inventory is not the same thing as supply. Inventory is what's sitting in a specific place, in a specific form, under a specific set of rules, ready to be delivered. Supply is what the world can actually produce and move on schedule. If you're a solar manufacturer, you can't melt down grandma's necklace. If you're an electronics plant, you can't accept random scrap with unknown purity. You need consistent feedstock, consistent specs, and consistent delivery. So visible warehouse stocks act like the shock absorber in a car. When the shock absorber is thick, bumps don't matter. When the shock absorber is thin, every pothole feels like a crash. And the other reason the 17 million ounces number is deceptive is this: not all ounces are equal in timing. Some of that metal is already spoken for through supply agreements. Some of it is held as collateral. Some of it is sitting because someone expects a higher price. Some of it is the wrong bar form for the buyer who needs it. And some of it can't leave without triggering taxes, paperwork, or restrictions. So the market can be well supplied on paper while being short in practice. That's why the premium forms first. The premium is the market's way of screaming, I need the right metal right now. And once the premium appears, it pulls metal out of the warehouse faster, because everyone starts front-running everyone else. This is how a decade low becomes a cliff, not overnight, but through behavior, which brings us to the next domino. Export ban versus export choke. The headline floating around is Global Export Ban. I want to be precise here. Not because I'm trying to calm you down, but because the details matter. What's on record is that China has tightened control over silver exports using licensing rules and a list of approved exporters for 2026-2027. In other words, the government is not saying anyone can export whenever they want. It's saying only certain companies under certain permissions during a certain period. That sounds bureaucratic, but in commodity markets, bureaucracy is the weapon. Here's how a ban rumor can be born without anyone lying. A buyer calls an exporter. Exporter says, we can't confirm ship date until the license clears. Buyer hears, no metal. A fabricator calls a refiner. Refiner says, we're prioritizing domestic contracts. Fabricator hears, exports are frozen. A logistics firm says, ports are slow. The market hears, shipments are stopped. And then one sentence goes viral, export ban. So my job is to separate the viral word from the operational reality. Operational reality is this: a licensing list and an approval process can produce the same effect as a ban, temporarily, for certain buyers, especially buyers who are not top tier, not pre-contracted, not favored, or not priority. And here's why it becomes global: because silver is not a huge market in tonnage compared to oil. It doesn't take a massive disruption to move it. If a few hundred tons of expected exports get delayed or redirected, the entire global supply chain notices. That's why a single policy change can ripple into higher premiums in Asia, tightness in Europe, and a scramble in the US all at once. Silver is small enough to squeeze and critical enough that people will pay almost anything to avoid a shutdown. That is the nightmare recipe. Let me make the export piece painfully clear, because this is where the ban language comes from. When a government moves a metal into a tighter export license regime, three things happen immediately. First, timing becomes uncertain. The metal might exist, the buyer might exist, but the shipment becomes a question mark. Second, the whole market becomes permissioned. If you're not on the approved list, you're not in the game. And even if you are approved, you still have to get every shipment cleared. Third, everyone starts hoarding domestically. Because if exports might slow, the safest metal is the metal already inside your borders. Now ask yourself, why would China do this? You don't have to believe any conspiracy to see the incentive. Silver is a strategic input. It sits inside power electronics. It sits inside solar supply chains. It sits inside medical and chemical processes. It's small per unit, but critical per unit. If global tensions rise, countries don't just hoard oil, they hoard the ingredients of modern industry. So an export license regime can be viewed as an industrial policy tool. Protect domestic supply, control flows, and avoid being caught short in a global scramble. And to the rest of the world, it feels like a choke. Because the world built supply chains on free flow. Now it's flow by permission. That is why buyers start whispering force majeure, because they understand if you can't guarantee exports, you can't guarantee deliveries. Because a licensing regime can behave like a ban without ever being labeled a ban. Here's how it works in the real world. You can have plenty of silver in the country, you can have plenty of buyers overseas, but if the paperwork slows, the approvals stall, or the shipments get delayed, the world experiences it as there is no silver available. And if you're a manufacturer in Europe, the US, Korea, Japan, India, and you built your supply chain expecting a certain cadence of Chinese exports, you don't care what the policy is called. You care whether your next shipment arrives. This is how export restriction turns into export shock. So when analysts say export ban, translated as export choke, export friction, export uncertainty, the kind that forces buyers to bid up what is already onshore. And now combine that with decade-low inventories. You can feel the trap closing, because in that environment, contracts don't break because of price. They break because of delivery. Which brings us to the biggest word in today's headline, force majeure. What force majeure really means, most people hear force majeure and think it's a dramatic phrase for bad weather. No. In commodity contracts, force majeure is the emergency hatch. It is a clause that can excuse or suspend performance when events outside a party's control make delivery impossible or impracticable. Here's what matters. Force majeure is not, I don't want to deliver because the price moved. It is, I cannot deliver because the world changed. And in metals, the world changed can be export licensing delays, port shutdowns, sanctions or compliance blocks, refinery outages, transportation bottlenecks, shortages of the right bar form, or a sudden legal prohibition. Once force majeure is invoked, the normal penalties for non-delivery can be paused or removed, depending on the contract. One more thing about force majeure that people miss, it doesn't always mean zero delivery. Sometimes it means partial delivery, delayed delivery, or delivery at renegotiated terms. In practice, suppliers may say, we will deliver what we can, when we can, and the rest will be deferred. That creates a second-order problem. Even customers who still receive some metal can't plan production. They can't promise their own customers. So the whole chain becomes uncertain. And uncertainty forces stockpiling. Stockpiling drains inventory. Inventory drain widens the premium. That's the feedback loop. So the moment force majeure language appears, it doesn't just reflect stress. It amplifies stress. So why are analysts whispering it now? Because when inventories are low and exports are uncertain, the probability of a missed delivery rises. And when one major supplier misses delivery, everyone else scrambles, and the scramble itself becomes the shock. This is why I keep telling you, silver is turning into an allocation market. In an allocation market, price is secondary. The primary question is, are you on the list? Let me show you how the chain reaction forms. The force majeure chain reaction. Imagine a simple supply line. Mine, refiner, wholesale bar, fabricator, end user. Now add the reality. There are bottlenecks at every step. The mine produces concentrate, not finished bars. The refiner needs time, energy, chemicals, and compliance clearance. The wholesale bar must meet specific exchange and industrial specifications. The fabricator needs consistent feedstock in the right form. The end user has deadlines that do not care about metal markets. Now drop 3 shocks into that system. Shock 1. Visible inventories are at decade lows, so there is no cushion. Shock 2. Exports are controlled by licensing, meaning flows can stop without warning. So, just in time becomes just not arriving. Shock 3. International demand spikes. This can be investment, industrial, or both, but the result is the same. More bids chase fewer deliverable bars. Here's the chain reaction. Step 1. The premium forms. Shanghai bids up physical metal because it's the fastest buyer in the room. Premiums appear over paper benchmarks. Step 2. Wholesalers tighten terms. They shorten payment windows. They demand stronger collateral. They refuse optionality. They quote subject to availability. Step 3. Fabricators start pre-buying. They don't wait for the best price. They buy to survive. They lock whatever they can because a shutdown costs more than a premium. Step 4. The hidden hoard becomes hidden. Entities holding metal stop leasing it, they stop lending it, they stop selling it into spot. They wait. Step 5, somebody misses a delivery window. Not because they're evil, because the metal isn't where it needs to be when it needs to be there. Step 6, the lawyer enters. Force majeure gets invoked, or commercial impracticability gets argued, or allocation gets declared. And once that happens, every other buyer panics, because now they understand the contract is not a guarantee of metal. It's a relationship with a supply chain. Step 7, the paper market starts chasing physical reality. Spreads widen, ARBs break, EFPs get stressed, borrow rates creep, backwardation becomes a symptom, not a theory, and that's how a supply event becomes a global price event. What force majeure looks like on a random Tuesday. Let me paint you a scene. You're not a trader, you're a procurement manager at a mid-size manufacturer. Maybe you make solar components, maybe you make connectors, maybe you make medical devices. You don't care about memes. You care about 3 things: spec, delivery date, and not shutting the line down. You have a contract with a fabricator. The contract says X tons of silver feedstock delivered monthly at benchmark plus a premium. Normal times that works. Then the calls start. First call, we're extending lead times. Second call, we're allocating. Third call, we can do half the order. And then the email hits, the one with legal language. It doesn't say, sorry. It says something like, due to circumstances beyond our control affecting export approvals and logistics, we hereby notify you that performance may be delayed under the force majeure provisions of our contract. That's the moment you understand you're not buying a commodity. You're buying access. Because you can't call a futures broker and fix a factory. You can't solder a circuit with a price chart. You need metal. So what do? You start calling everyone. You start bidding up scrap. You start paying premiums you swore you'd never pay. You start rewriting product designs to use less silver. You start asking whether you can substitute, whether you can delay shipments, whether you can find another supplier. And here's the punchline. Your scramble becomes someone else's shortage. Because when 1,000 procurement managers do that at once, the physical market stops functioning like a market. It becomes triage. That's why I'm treating the force majeure chatter as a real signal, not because I enjoy drama, but because I've seen this movie in other commodities. When force majeure spreads, it doesn't spread on CNBC. It spreads in emails. It spreads in quiet calls. It spreads in new contract language. And by the time it hits headlines, the metal is already spoken for. Because silver is connected. If Shanghai pays $90, $95 for deliverable metal, Western markets cannot ignore it forever. They can ignore it for days. They can ignore it for weeks. But not forever. Eventually, either paper reprices upward or physical disappears. Why arbitrage doesn't instantly fix this? At this point, a smart viewer asks, if Shanghai is higher, why don't banks buy silver in New York and ship it to Shanghai until prices equalize? In textbooks, that's exactly what would happen. In the real world, there are 4 walls. Wall 1, form and specification. An exchange contract might be deliverable in 1-bar form, while a local buyer needs another. Even if both are silver, the supply chain treats them as different products. Wall 2, time. A paper spread can change in minutes. A physical shipment takes days or weeks. If the premium is driven by urgency, you can't catch it with a slow boat. Wall 3, paperwork. Customs, compliance, licensing, certificates of origin, assays, logistics contracts, all of it can delay movement. And in an environment where export approvals are getting tighter, paperwork becomes the bottleneck. Wall 4, balance sheet and credit. To run a large arbitrage, you need financing. In a volatile market, financing gets expensive and credit committees get nervous. So the RB that should happen happens slower, so the premium can persist. And when a premium persists, it tells you the market isn't just mispriced, it's constrained. That's why Shanghai's premium is a signal, not an opportunity. It's the smoke coming out of the machine, and force majeure is the formal language of physical disappears. Why this is happening now. So why now? Why not last year? Why not 5 years ago? Because this isn't one thing, it's a pileup. And yes, there's a macro backdrop pouring gasoline on this. You have a world where gold is printing record levels and silver is ripping right behind it. You have political uncertainty, spooking markets. You have currency volatility. You have investors looking at institutions and asking what's real, what's durable, what can't be printed. In that environment, metals don't move like they did in sleepy years. They gap, they surge, they force rehedging, they break models. So when you see silver pushing into new records on Western screens while Shanghai is paying a premium, understand what's happening. two forces are stacking, financial demand and physical demand. That's the dangerous mix, because financial demand is fast and physical demand is sticky. When both show up at once, the market can run out of available silver long before it runs out of silver in the world. Because this isn't one thing, it's a pileup. Let's stack the pressure points. Pressure point 1, a safe haven stampede. When institutional stability wobbles, money runs to hard assets. Gold does it first. Silver follows when the move becomes a crowd. Pressure point 2, silver's dual identity. Silver is monetary and industrial. So in a risk-off moment, it gets investment demand. And in a manufacturing moment, it gets consumption demand. That dual demand is why silver squeezes are violent. Pressure point 3, visible inventory is low. The warehouse buffer is thinner than people assume. When buffer is thin, any disruption becomes a crisis. Pressure point 4, policy friction. Export licensing turns a global commodity into a controlled stream. And controlled streams create price islands, Shanghai here, New York there. The ocean in between is paperwork. Pressure point number 5, the psychology shift. When buyers believe shortages are possible, they behave in ways that create shortages. They front run, they hoard, they prepay, they double order, and the chain tightens further. This is the self-fulfilling loop. Fear of shortage, behavior that drains inventory, tighter physical market, higher premiums, more fear. And once that loop starts, the market changes character. It stops being a smooth chart. It becomes a sequence of interruptions. That's why you're hearing force majeure. Because force majeure isn't about price, it's about interruption. The Shanghai Premium is a warning, not a trophy. Let me tell you what I don't want you to do. I don't want you to stare at the $95 headline and celebrate like it's a lottery ticket, because a Shanghai Premium is not good news in the normal sense. It is a warning light. It says, the system is paying extra to pull metal forward in time. In other words, the market is borrowing from tomorrow to satisfy today. When a market borrows from tomorrow, tomorrow becomes fragile. And that's why the most important number is not $95. It's the spread between physical hubs and paper hubs. If the physical spread widens, it signals arbitrage is failing, logistics is strained, someone who needs metal is willing to overpay to not shut down. That is not a trophy. That is a supply signal. So what do you watch? La Tumbom. The three prices of silver. When a market transitions from commodity to allocation, you stop having one price. You have three prices. Price 1, the screen price. This is what you see on a chart. Fast, liquid, tradable, but it's not a promise of delivery. Price 2, the wholesale price. This is what big buyers pay for good delivery bars, in size, with settlement terms. It includes credit conditions and the reality of supply availability. Price 3, the delivered price. This is the all-in cost for a specific form of silver, delivered to a specific location by a specific date, with the paperwork cleared. In calm times, those three prices sit on top of each other. In stress times, they split apart, and the gap between them is where panic lives. That's exactly what Shanghai is showing you. The screen price can be one thing. The delivered reality can be another. Now, here's the scary part. Allocation markets feed on themselves, because once suppliers start allocating, buyers stop trusting the supply chain. And once buyers stop trusting, they change behavior. They overorder. They prepay. They demand priority. They sign longer contracts. They build safety stock. They buy insurance ounces. All of that behavior pulls metal forward and drains inventory further. So the system doesn't just get tight, it gets brittle. And brittle systems don't fail smoothly. They fail in jumps. That's why you can wake up one day with tightness and go to sleep with force majeure. Now, I want to address something directly. People hear force majeure, and they assume it must be a single catastrophic event, like a hurricane. But in commodity logistics, catastrophe can be administrative. It can be legal. It can be compliance. A shipment can be blocked because of one missing document. A cargo can be delayed because a port changes inspection rules. A bank can refuse to process payment because a counterparty triggers a compliance flag. A license can be delayed because a ministry is reviewing. None of that looks like a disaster on television. But to a supply chain, it is a disaster. So when you hear force majeure, don't imagine lightning. Imagine a door that won't open. Imagine a stamp that doesn't come. Imagine a container that sits. That's the modern choke. And now put it back into our story. Decade-low Chinese inventories, a licensing choke on exports, and global buyers trying to secure metal at the same time. This is why Shanghai is the early warning system. It is the place where buyers can't escape into a spreadsheet. They have to actually source bars. So yes, the $95 equivalent chatter matters, not because it's a trophy, because it's a stress test result. Here are 5 signals that matter more than Twitter. Signal 1, the benchmark conversion spread. Track the Shanghai benchmark in RMB Kg and convert it to USD Oz. Then compare it to COMEX spot futures. If the gap widens and stays wide, the physical market is asserting itself. Signal 2. Warehouse stocks. Watch SHFE on warrant stocks. Watch exchange inventory reports where available. When stocks fall and do not rebuild, the cushion is gone. Signal 3. Backwardation behavior. If near-term delivery becomes more expensive than forward delivery, the market is paying for immediacy. That's what stress looks like. Signal 4. Subject to allocation language. When wholesalers and refiners quietly change their contract language, that's the pre-force majeure stage. It's the system preparing to ration. Signal 5. Export approval chatter, not headlines, actual lead times. If a process that normally takes days begins taking weeks, you will see it in premiums before you see it in news. Those 5 signals tell you whether this is a headline or a regime change. The Western paper market problem. Now let's address the elephant in the room. How can Shanghai be near $95 while the West is near $85? Because paper can float above reality until reality demands settlement. Paper markets are incredible at price discovery, but they are not designed to guarantee physical availability for every participant. That's not a conspiracy statement. That's structural. Here's another layer people misunderstand. ETFs and paper-silver products can track price, but they can't magically create metal. In calm markets, that distinction doesn't matter. In stress markets, it matters a lot, because if physical metal becomes hard to source, the ecosystem around paper instruments starts to show friction, spreads widen, premiums, discounts appear, creation and redemption becomes more complex, and liquidity gets patchy at the exact moment everyone wants liquidity. That doesn't mean paper is a scam. It means paper is a different tool. A futures contract is a leverage tool. An ETF share is a market access tool. A bar in a vault is a supply tool. A bar in your hand is an optionality tool. Different products, different risks, different behaviors when the system is stressed. So when Shanghai screams with a premium, it's the physical layer yelling at the financial layer. Stop pretending you're the only price. And eventually, one layer forces the other to adjust. A futures contract is a tool. It can be closed, rolled, offset, or settled financially. Physical delivery exists, but the system assumes most people won't take it. In normal times, that works. In stress times, people start asking, what if I want metal? And that question is what breaks complacency. When the physical market tightens, what you often see is bigger spreads, sudden volatility, and a war between price and premium. And here's the hard truth. If you need silver for production, you don't care about spot. You care about delivered, in spec, on time. That's why Shanghai matters. Shanghai is one of the places where metal actually changes hands as metal. So if Shanghai is paying up, it tells you someone is paying for reality. The 3 scenarios from here. Let's map the next moves. Not predictions, scenarios. Scenario A. The paperwork clears. Export licenses flow. Warehouse stocks stabilize. The premium narrows. Price cools but remains elevated. Scenario B. The slow squeeze. Licensing delays persist. Inventories drift lower. Premiums stay sticky. Price keeps climbing in bursts. This is the grind higher scenario, and it's the one that destroys short sellers slowly. Scenario C. The snap. A major supplier, refiner, or shipper misses delivery. Force majeure gets invoked. Allocation language spreads. Premiums explode. Paper tries to catch up. Price moves in violent air pockets. You want to understand something? Scenario C doesn't require a global catastrophe. It only requires a thin cushion and one jammed door. That's how tight systems fail. Not with fireworks, with one locked hinge. What could deflate this? To stay honest, we also need to talk about what could relieve the pressure. Because markets don't go one way forever. They swing, they breathe, they punish certainty. Here are the release valves, and why they're hard. Release valve 1. Inventory rebuild. For the premium to fade, warehouses must refill. That means metal must arrive in size, in spec, and be willing to sit for sale. In a fear loop, that's difficult. Holders don't want to be the first to sell. Release valve 2. Recycling surge. High prices can pull scrap into the market, but recycling has its own bottlenecks. Collection, refining capacity, and time. And recycling rarely arrives fast enough to solve an immediate delivery crunch. Release valve 3. Substitution. Manufacturers can redesign to use less silver or switch materials in some applications. But redesign also takes time, testing, and approvals. And in many high-performance uses, silver is not easily replaced. Release valve 4. Demand destruction. If price and premium get high enough, some demand stops. But for critical uses, demand doesn't stop. It reroutes. Companies will pay to survive before they shut down. Release valve 5. Policy clarity. If export licensing becomes predictable, approvals are fast, Flows are steady, panic fades. Uncertainty is the fuel, clarity is the extinguisher. So yes, there are ways this cools. But notice the theme. Every release valve is slow. And when the release valves are slow, shocks matter. That's why you can't dismiss a Shanghai Premium as just noise. It's the market telling you the release valves aren't opening yet. What you do with this information. I'm not here to tell you what to buy. The next 72 hours checklist. If you want something practical, here it is. A checklist for the next 72 hours of trading and headlines. Again, not instructions to buy or sell. Just signals to keep you from being surprised. Watch the Shanghai benchmark print, not the rumor, the print. If the RMB KG benchmark stays elevated and the converted USD AUD stays far above New York, the physical premium is persistent. Watch whether the premium is intraday or structural. An intraday spike can be panic. A multi-day premium can be a supply shift. Watch currency. If USD CNY moves, it changes the converted price even if the RMB benchmark is unchanged. So don't misread FX as silver movement. Watch for language changes from suppliers. The biggest tell is not a chart. It's the words allocation, prioritization, subject to availability, extended lead times, pending approvals. Those words are the pre-quake tremors. Watch for any official updates on export licensing. If authorities issue new guidance, new exporter lists, or new compliance requirements, that can change flows overnight. Watch the gap response in the West. If New York starts catching up rapidly, you'll see it in sharp spikes and volatility. If it doesn't catch up, you'll see it in physical premiums and delays. Watch for the first big public force majeure notice. You might not see it on mainstream news. You might see it in trade circles. But once a major supplier uses that language publicly, the market will price the risk of more, and one more. Watch your own emotions. Tight markets are designed to bait you into impulse. Your edge is calm. Your edge is reading the system, not reacting to the noise. That's the battle plan. Watch the spread, watch the stock, watch the language. I'm not here to tell you what to buy. I'm here to tell you what to watch so you're not blindsided. If you're a trader, respect the spread, respect the volatility. In tight markets, stops get hunted and liquidity vanishes. If you're an investor, understand the difference between paper exposure and physical ownership. Paper can track price. Physical is about availability and optionality. They are not the same product. If you're an industry, your risk is not the price chart, it's the delivery schedule. And in a force majeure environment, procurement becomes survival. This is why I keep hammering one line. The price is not the story. The delivery is the story. The final warning. Let me end with this. When the world starts using force majeure in a metals market, it means the system is preparing to excuse failure. That alone should make you pay attention. Shanghai paying 90.95 equivalent is not a meme. It's a message. The message is physical is tight, exports are controlled, demand is not slowing, and the cushion is thin. So the only question left is, how many shocks can this system absorb before it has to ration? Because rationing is what force majeure becomes in plain English. Before we close, let me hit the questions I know you're already typing. Q1. Is Shanghai more real than COMEX? Shanghai is closer to the physical handoff in many cases because a lot of participants there are sourcing metal for use. COMEX is a global hedging and price discovery engine. Both matter, but when physical is tight, the physical hub speaks louder. Q2. Does this prove manipulation? A premium doesn't prove manipulation. A premium proves friction. It tells you metal isn't flowing freely or buyers are paying for immediacy. The cause can be policy, logistics, demand, or panic. Often all at once. Q3. Why would anyone sign a contract if force majeure can cancel it? Because force majeure is supposed to be rare, but rare becomes less rare when supply chains are stretched and policy becomes unpredictable. Contracts are still valuable. They just aren't invincible. Q4. Can miners fix this by producing more? Mining is slow. Permitting is slow. CapEx is slow. And most silver is produced as a byproduct of other metals. So supply doesn't respond quickly to price spikes. Q5, what about government stockpiles? Maybe they exist, maybe they don't, and even if they do, releasing them is a political choice. Markets can't rely on hidden supply, they rely on visible flow. Right now, visible flow looks constrained. Q6, if Shanghai is higher, shouldn't I just buy there? If it were that simple, the premium would vanish. Access, paperwork, bar form, and timing are the barriers. Retail viewers don't get to teleport metal across borders in the correct form overnight. Q7. So is $95 guaranteed? Nothing is guaranteed. Today's story is not a number. It's a mechanism. Premium, inventory, export friction, and demand. Numbers are outputs. Mechanisms are causes. Q8. What's the most important takeaway? Stop watching only the chart. Watch the physical signals, spreads, stocks, and language. When those three turn, the market is changing character. All right, now let's wrap this with the one sentence that matters most. When you see the next wave of headlines, run them through this filter. Did anything change in flow? Did anything change in inventory? Did anything change in contract language? If the headline is just silver is up, ignore it. If the headline is shipments delayed, licenses tightened, suppliers allocating, or contracts under force majeure, that's real. Because those headlines change behavior. And behavior is what moves a shortage. And remember, in an allocation market, silence is not comfort. Silence can mean the deals are happening off screen. If you want more updates like this, subscribe, because this is moving fast, and the next headline won't be polite.